Today we have with us Bryan Menell. Bryan, thank you so much for joining us.
Thank you for having me on.
I'm very excited to have Bryan, who has a lot of experience on both the buy side and the sell side, having launched multiple companies and also acquiring multiple companies. So Bryan, please kick us off and tell us about the first business that you sold and how that process went.
Very first one, I think it was in my late 20s. It was a service company I'd started, and we just found a niche at the time. We were helping other technology companies deploy CRM software. And at the time, the industry was going from homegrown CRM systems to buying packages. They never before had, this is a long time ago, never before had been able to buy a software package for your CRM system. And so our partners would go sell them, and we'd clean up behind them and go implement them and customize them and make them work. And caught the attention of a company. This is actually how I got to Austin, but it caught the attention of a company out of Houston. I was recruiting people in Houston for a Houston office because we were expanding and growing. Met a recruiter, and he said, you remind me a lot of this guy that I know who's an entrepreneur, and he's grown this big services company. You should just meet, just have lunch and whatever. So we met, had lunch, hit it off. And we had no capital in the business, so I was trying to grow the business without any outside capital whatsoever, which is really hard. We only grew at a certain rate out of cash flow. And eventually convinced me to just join forces and kind of build my CRM group within his company because they had resources to hire people and whatever it is. So that was the first one I ever sold. Had no idea what I was doing. The goal was we wanted to get all the paperwork done by 12/31 and have a clean start, right? So the deal was done 12/31, and January 1st, everything was start be easy to do, tax returns, all sorts of things. And so to do those things, right, you have to have certain deadlines you're trying to hit. Well, it turns out Christmas Day, I was visiting my family in California on Christmas Day, and we had an 8-hour conference call to hammer out deal points. Like, we had to get it done that day in order to get everything else complete by then. So I was on an 8-hour conference call, me and my attorney, the buyer, their attorney, basically, and we were on the phone. We'd take a break to eat for a half hour and then get back on the phone. My family hated me. To this day, they still remind me of the Christmas that I was on the phone all day on Christmas Day. But we got it done, though. Closed 12/31, and that was a great deal, for everybody, actually for a while. So the reason I actually wanted to sell to these guys was because they had an S1 in hand. They're getting ready to go public and file. So they were a private company. So I'm exchanging my shares in my private company for their shares in their private company. Still doesn't help me pay my mortgage, right? But they've got an S1 in hand, and they're going to go file and then get some liquidity, right? And then they didn't. They ended actually up selling to a bigger company for more money than they would have gone public at in terms of valuation. Seemingly great deal. And then that acquiring company that acquired us, before we even got our stock certificates in the mail, turns out they were cooking the books. This is long before Enron. They were pioneers in fraud, and they suffered the biggest one-day stock drop in NASDAQ history in their stock. And we hadn't got our shares yet. So just okay, great. So that all went awry,
Oh,
Who could foresee that? Nobody could, obviously. There were people that had much bigger dollars at stake than me by far who were just, devastated and whatever. But, crazy things happen.
So what would you have done differently in that first deal, knowing what you know now?
There's no due diligence I could have done that could have seen that happen, So just things happen. You just got to pick up, start the next one. I left to start another company. We tried to stick it out, actually, and go actually buy back our company from the parent company, with the financing to do it. But it just it didn't work out that way. And so I just left and started another company.
So let's talk about the other company.
So that company largely was very similar business to the one that I sold. So we partnered with technology companies and helped implement their software. But what changed was that that old company was old technology. At the time, it was called 3-tier client server technology. And this is 97. This is when the internet was getting big. So it largely was the same type of business, but with internet-based software instead of actual client server installed technology. And just got lucky. A lot of things happened at the same time. Number one, it's the tech boom, right? So things were growing very rapidly. We got lucky in our first software partner was a company here in Austin called Vignette Software that was just growing leaps and bounds. Had more business than we could do, right? We would, if you could spell Java, we'd hire you and put you out in the field and do work. And then that company ended up taking public in 1999. But it was just the same type of company as I'd done previously, just in more internet-based technology because it was sexier and it was the newer stuff and harder to find people with the skill set at the time. So it was people like, oh, that's really cool that you would do that, but it was the exact same business I had before, just with a different sort of technology thing. So I kind of knew the playbook in terms of how that worked, but didn't expect to take it public, but it was just more happenstance that it worked out that way in terms of meeting the right people in the right situation and whatever that resulted in that.
What was what prompted the decision to go public versus getting acquired?
It was all people, like relationships. So in the process of this other company, I had met some folks. I met a guy who was, two guys. One was a director of finance at a company called Blockbuster, and the other one was an attorney that had done all the paperwork. So the finance guy would go find the mom and pop video stores for in every little town for Wayne Huizenga and go make a deal to acquire the company. The attorney would go do the paperwork and roll them up, and the two of them just went across the country and just acquired tons of mom and pop video stores and created the Blockbuster nationwide empire. So they knew how to, and Blockbuster was public at the time, so they knew how to go acquire companies with public stock and do, in essence, a roll-up strategy, nationwide roll-up strategy. So I met them, and we just talked about like how to grow the business. And they said, well, have you ever talked about or thought about doing a similar type of roll-up strategy? Because there was hundreds of companies like mine, 20-person services organization all across the country that really, as a 20-person services company, like hard to attract venture capital, hard to find an exit, right? Your backlog of projects looks like, you're out of business in 6 months because your client projects are done, right? So it's hard to get liquidity. So it's like, great, well, we could go roll up these smaller companies and, get them liquidity because the stock is public, and then use the public stock as the tool to go do things. So I just met these guys. One was on my board. The other one came on board as CEO and had the relationships because he was an attorney out of New York. He had the relationships in New York with an investment banker that could do the IPO. It was a small cap IPO. It wasn't big. And then it was just off the races, right, until 2000 hit.
Yeah. How long did the whole process take of going public?
It wasn't that long, really, because this is a very small cap IPO. It's like $25 million IPO, which is like one check from somebody. Not really, but but it's pretty small. So CEO did a roadshow in New York and a couple of those cities. Not long, 7 days, I think, if I remember right, and just got it done. So it was relatively quick because it wasn't a big amount of money. And then we had all ready to go, and then it was just a matter of like figuring out the process to go find the right companies, find an investment banker that could go scout and do all the phone calls and do all the research and find the people. I think we went through, I think it was about the third investment banker we found that really got it in terms of what we were looking for and found the best quality companies. So I think we went through a couple before we finally found the one that really worked out well for us.
So let's talk about that, because this is where you basically are on the buy side. You're now looking to buy companies. So how did you find them? What were you looking for? And what were some of the things that maybe the bad investment bankers weren't getting that the good one did?
So we were looking for, in that business, you want to find like a sort of a technology practice that has a complementary skill set to what you do, right? So we had relationships with companies like Portal Software and Vignette and those sorts of things. So ideally we find someone that's kind of like us, but their relationships are with, companies building data warehouses or whatever, right? So something that we're not doing. So that it's complementary to what we're doing. So when you couple together like 3, 4, 5, 6, 7 of these, you have distribution of different types of businesses that you're in. So you have less risk in terms of one niche that you're in. Looking at it as a whole, you look like a very diversified technology company, right? So you look better to the outside. So we learned that complementary in terms of geography worked out well. So we were big in, Texas, Southwest, Midwest, whatever. You acquire somebody who's big on the West Coast, like, great. It's very complementary. Because if you acquire someone who's got an office down the street, then it's like, okay, do you come to our office? Do we come to your office? Like, do we find a bigger office together? Like, who really is who's the bigger practice here? Who's like, we're going to use our processes and procedures. Like, you have that contention. So complementary always worked, better for things. And then another thing that we learned around that time and also later was, in terms of integration, was like the mindset of people when they get acquired. We had this sort of game plan we developed even early on, but you acquire a company, you give them 30 days to just kind of keep doing what they're doing, and not change anything and not make anything happen. And they're kind of absorbing the shock of the people, like, okay, it's going to be something they knew. And then there's this period of time when, like, you leave Friday at 5 o'clock and you're part of your previous company, and then you come in Monday morning and now you're part of this new company. You've got a new computer, you've got a new phone on your desk, you've got a different badge, the name on the wall is different. Like, you're now part of company X. That company is gone. Now you're part of this company. And it's super important because a couple things happen. People have to make a decision in their minds, like, I'm either on board with this or I'm not, right? So they're like, yes, we're part of bigger company X. Cool, I love the mission. Like, great, like, I'm on. Or they're like not going to make the journey, right? So you're trying to figure out, like, who's in, who's out. Ideally, like, everybody stays, right? Doesn't always happen that way. Sometimes these things happen and, like, the top talent walks out the door. Man, that's, like, really rough, right? Like, that's a deal that does not work out because the better people walk out. So there's ways that you sort of, like, get people bought in, and then you can't just, like, leak it in slowly and do things. Like, you got to, like, pull the Band-Aid off and then figure out who's in, who's out fast, right? So people check out, right? But they check out in two ways. They check out either privately, where they only tell their wives that, like, this sucks, I don't want to be here anymore, and they kind of phone it in, or they tell their coworkers or their boss, like, I don't want to be here, this, like, sucks. And if they publicly check out, like, great, you just move on, you're gone, because you just pull the Band-Aid off. But ideally, the majority stay with it and move on. But kind of a lesson learned in terms of integrating people. Like, you just have to get them on the boat at a certain period of time, and just like all knew everything, right? I got a new business cards on my desk, a new phone on my desk. Like, they got to feel like this is a new dawn, new day, like start a new company, and sort of like a acquisition game plan, playbook in a way.
What advice would you have to founders who are about to be integrated into another company, or maybe are considering multiple offers, knowing that they're going to be integrated into one of those companies?
Multiple offers is a whole other thing, right? So being integrated, you got to kind of figure out, like, where are my people, like, going, right? How do they fit in? Where do I fit into this company? What's our role? How do those things happen? Who's reporting to who? There's a lot to figure out. In terms of the other side of that, in terms of like where you're, how you go and how you're going to fit in. Oh, multiple offers, like, scenario is really, like, different too, because typically, if you're not looking to sell, like, someone shows up at your doorstep, right, and they're like, hey, I really like what you're doing. Like, you get a call from the corporate development guy, right? Says, hey, like your stuff. Let's talk, right? And then you're getting bought. Someone's interested in what you're doing, and that's great. Like, 'cause it's a great feeling. Like, wow, people are really interested in what we're doing. There was a company that a friend of mine started and convinced me to come on board as CEO. And it was just like the two of us. It was super small. It was young. We hadn't even fired our first customers yet. And my first week in the job, like, I had a phone call from a corporate dev guy at a huge company that's now public, multi-billion-dollar company and whatever. And you're like, wow, this is, like, cool. Like, they're really interested in what we're doing. And they want to give you a term sheet and, like, okay, want to acquire you and, like, whatever. But then you have a decision to make. Like, well, this is what they're offering me, but is this the market value of my company? Like, you don't know because you got one offer, right? So then what do? Well, you get another term sheet, right? Like, all right, who else might be interested? But then that's a lot of work, right? Now, instead of running my company, I have to go call companies I think that might want to acquire me, right? And open up the conversation in some way. while keeping this other one at bay, right, without signing a term sheet or committing to a no shop, right? Now I got to go like, okay, well, who else in the industry might be interested? And that's a lot of work, right? Or you hire an investment banker and just like, hey, go shop me around to sell me. Like someone's interested, so maybe I'm interesting, go, make some phone calls and see what's there. But then your buyer that you had in your pocket like might walk away and be like, oh, I didn't want to go be a part of a process where you're going to sell the highest bidder. I just wanted to, buy you because I thought you were interesting, right? So you might lose them and have them walk away. So it's really tricky when you get that first. And it's probably happens to a lot of entrepreneurs. Like you just get that call like, oh, big company X is like really interested in us. Like, what should I do, right? So, and then it's just in terms of the entrepreneurs, from my perspective, it's kind of a game in a way that you have to play the right way. Like disinterest is your best friend. Like the first call, they go, wow, we're really interested. And you go, oh, we're not selling, right? Oh, you sure? Oh, I'm positive. Why not? It's like, well, we're still two guys and a dog in the office. Like, we didn't start this company to go sell for $10 million to some Silicon Valley company and then go be wage slaves to you guys, right? Like we built this to be $1 billion company, go away. And then, they do, and then they come back 30 days later and they go, well, what if it was not 10, what if it was like 15 million? Like, would that be different? So disinterest is your best friend. Like, I always tell, I mentor and work with companies that are sometimes in this position. I tell them like, you want the potential buyer who flew in your window, you want to tell them that you're on this path to being a $1 billion company. If they're going to distract you off that path, like it better be a really interesting offer, right? To like distract us from going here because I'm focused on this. Like you're taking up my time talking about this, like that I don't need it or want it, right? So, because then they come at you harder and faster. If you're super interested, it's like dating, right? It's like, who's more interested, like you or the other person. So like disinterest is your best friend. Like you just have to play this weird game of keeping them at bay to get them more interested to increase the price, right? Or find multiple bidders, like other people that might be interested on the down low in a way. So it's hard. And the worst part is it's time consuming, right? If that first one comes in and you're going to go find 3 more or something like that, you're probably committed to actually doing some sort of transaction because it's going to suck up all your time and you're going to stop running the business and you're going to start looking for a deal and a transaction. So you kind of have to decide like if it's yes or if it's no. Like if it really is no, like no, just no, go away. Like great, just tell them no and make them go away because they'll come back, in 3 months or 6 months. Like they still want to keep in touch with what you're doing. But so it's very hard. It's like the choice to make, right, when that interest comes in. And it happens all the time, I think, right? There's like one company that we were talking to, like I did some research on them. Like they acquire 14 to 30 companies a year, right? They have an M&A machine. This is like what they do. Like they outsource innovation and acquire companies. So, and to acquire those 30 a year, they're talking to 300, right? So there's lots of conversations going on, lots of entrepreneurs, guys at young startups like me, they're getting lots of inbound, right? So, and nobody teaches you in MBA school how to handle inbound interest from corp dev, right, in terms of the right way. But usually if your attorney is good at, or your board, right, or your advisors are experienced, like they'll sort of, steer you right, like, okay, here's how we should handle this. Here's how we should respond. Here's how we should do this to just sort of play the game right to maximize value if that's what you're after for your shareholders and yourself.
When is the right time to sell?
When things are going shitty, right? If things are going well, you don't want to sell, right? So when growth slows down, operational challenges get to be more than you can handle, right? Or you can't raise capital, and you see the cash dwindling at a certain point, you need to do a deal. Nobody sells when things are going well, right? So, I mean, when you see the news locally here in Austin, oh, so-and-so sells for like whatever, we go, oh, congratulations. But like deep down you go like, oh, something was not going well, right? Unless they just like totally backed the gold truck up at your door and dumped it off, like then, yeah, that's like great. But usually like you're selling for a reason, for whatever reason. So time to sell, I would say, is when the growth rate slows down because multiples are had for strategic reasons and also for growth multiples, right? So when the growth starts to slow down, time to think about, bailing out.
So during that time period, how do you make your company attractive to buyers?
I've done this before, right? You got to put the lipstick on the pig and make it look good. Typically, as you're slashing costs, you're reducing R&D expenses. You're no longer investing in the future. Long-term things that will pay back a year down the road, 2 years down the road. You're cutting all those things to put that money at the bottom line, to make the bottom line look better. Because there's two types of buyers, right? There's strategic buyers. They're buying you because your technology is going to make them worth $1 billion more, right? Or they're buying you for cash flow. Like you put $1 million to the bottom line every year, and so we'll buy you for 7 times cash flow because that's what the discounted cash flow model says. And so we'll do those kinds of deals like all day long, right? So ideally, you're never bought for cash flow because that's going to be the smallest number you're going to get. Ideally, you're bought for some strategic technology relationship, something that you have that somebody is going to buy you for $20 million, but they're going to use your technology to go make $1 billion next year off, because they have bigger scale than you do, right? So that's the ideal, because then what are you worth? You're worth a lot more than the cash flow. You're worth like a lot of money to them because they're going to use you to make $1 billion, right? So you're worth $1 billion. You're not worth 20 million. They're not going to pay $1 billion, but you're going to get more off the strategic multiplier than on the cash flow model.
When's the right time to bring in an investment banker? What types of deals should you bring in an investment banker for?
When you're selling, if you want to sell. So my opinion on investment bankers is that the right investment banker has a tremendous black book, right? You're like, I'm ready to sell. Go shop me and find a deal. And the right iBanker, they know the person at the buyer that you want that makes the decisions and looks at deals and companies. So they're going to go build a book for you that they can distribute. They're going to make 10 phone calls to the guys who buy people just like you. So their big value is their black book and their relationships with those companies. I don't believe, however, that investment bankers are the best people to maximize the value of your company for you. In my experience, the entrepreneur is the better negotiator on the deal than an investment banker. Because investment banker, depending on how you structure the deal, like their minimum, like their take minimum is like $1 million plus a success fee plus a whatever. But getting an extra $2 million for you doesn't really mean a whole lot to them in the grand scheme of things. They just want to get a deal and get the money. They don't care about maximizing the extra little bit for you that might make the difference for you. So, in my experience, investment bankers are their value is the Rolodex, not the negotiation part of the deal. But also keep in mind that the investment banker is not your friend. They're the friend of the company buying you, right? So they're shopping you to big company X, right? They're shopping you to the head M&A guy at Google, who's their best friend they play golf with. Well, they're going to have that relationship with the corp dev guy at Google for the next 30 years, ideally for them, right? So for them, in that transaction, like you're just one more deal coming through the flow. So they're not incented to go mess up that relationship to get you the best deal. They just want to get a deal, right? You see what I'm talking about? Mm-hmm. Plus, sometimes those investment bankers will have other services. Like they will help employees sometimes get liquidity on stock before IPO or whatever, right? So they want all kinds of money from that big client of theirs. It's a huge revenue stream, and you're just one deal in many deals, right? So they're not really your friend, right? They're really the friend of the company selling you to. So you need to utilize that relationship to your benefit in the best way you can, and just understand, like, follow the money, and you can follow where the incentives are for things.
Did you use an investment banker for all the companies that you've sold?
I have never hired an investment banker for any companies I've sold, no.
Oh, interesting.
At Proficient, which was public, we hired an investment banker to go find companies on the buy side. But I've never hired an investment banker to go shop and sell a company. Very
interesting. So from the buy side, how did you find your investment banker? What were some of the criteria you were looking for? In
the companies I've been involved with, I was not the person that shopped and found the right ones. But the companies I've been involved with, I know it's typically been like a fit and their ability to just find the right ones that are a good fit. So you'll give them the criteria, they go and search, and what they bring you, you look at, and you figure out, like, well, is that really what we're looking for or not, right? So if they're bringing you things that aren't a good fit, they're just wasting your time, right? So So sometimes you'll try one for a while, see what kind of deals they bring you, and see if they just sort of really get what you're after. It's no different than like a headhunter. You're like, I need a stellar VP of sales, and they throw you some people, and you're like, this isn't the kind of guy I was thinking at all, right? So you just you hire a different headhunter and say like, well, now you go find me some VP of sales. Like, oh yeah, like you get me, you know what I'm really looking for, right? So the same kind of thing. They're going to bring you companies that kind of have that fit that you want, and so when they consistently don't, you just know you need to move on. Big companies, imagine, just hire maybe multiple for different industries. Like someone who's great in finance, someone who's great in this. Maybe you have different people so you can compare and contrast. But typically, you've got the time and money to hire one to go do some things. So it's a little bit of just a dating process to find someone that seems to bring you the right things that you want.
Having been on both sides of the table of buyer and seller, what recommendation or advice would you give to companies selling their company about the due diligence process?
There's a lot of things. Number one, like I sold one company to a company that had never acquired a company before ever in their lives. And then I had almost sold a company to a company that acquires 30 a year, right? So, and from the entrepreneur side, the experience is totally different to work with somebody who knows what they're doing to someone who has no clue what they're doing, right? And so it's a much better process for me with someone that just they know the steps, 1, 2, 3. Here's what we do next. And it goes fast. It's less expensive in terms of attorney's fees. It just boom, 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 and gets done, right? And they know how to integrate you too. Once they acquire you, it's just a machine. So if you get approached by somebody, one of the first questions you look at is well, how many companies do you acquire per year? Are you good at doing this, right? How many do you talk to? How many end up doing a deal, right? And then from a diligence perspective, I would say well, hey, could I talk to 3 CEOs of companies you've acquired in the past 2 years and ask them, how's their experience been? How did the deal go? Negotiations, what are they still doing with the company today? Have they enjoyed, because ideally they want to acquire you, you want to stick around for a while, not just get paid to go away, right? So there's lots of questions, in terms of qualifying these guys you can ask. And if they don't acquire a whole lot of companies, just know it's going to be kind of a rocky road. Because they just don't know what they don't know. And then same with the attorneys on their side buying you. You got to research them. Is this what you guys do all day long every day? Or is it oh, my neighbor will do the deal. And because my neighbor is an attorney. An attorney is an attorney, right? But, not all are created equal. So you want to make sure that, these people they do this all day long because they just know how it works, right? And then the thing that, I don't know how long it took me to realize this in terms of negotiating these things, but, you get a term sheet and it's okay, here's how much and whatever, and then great, let's go let the attorneys do the paperwork on this. But then the paperwork process is the whole process is just shifting risk, right? It's trying to figure out the whole list of possible things that could go wrong, and if it does, whose fault is it and who pays, right? So every aspect of what you have to look at and understand is just the risk shifting. And then if you've chosen the right attorney, they're just really good at explaining to you more in plain English or in business terms, what risks we're talking about and who's taking on that risk. What happens if, and trying to explain that. And then the whole thing is just risk. Who's absorbing the risk for this, right? Is that my fault or is that your fault? You take my technology, you go deploy it to 20,000 customers that you have, and then the technology stops working. Well, and that costs us $800 million in damages or whatever. It's okay, that's your fault. Well, wait a minute. I'm not making $800 million off this deal to begin with. And also, those are not my customers, right, too. So, they'll try to shift as much risk onto you as possible. And then, ideally, you're not trying to accept, that much risk. But in the best of all possible worlds, when you get done, you have a 120-page document that you toiled over for 60 days that everybody signs, and then it goes in a drawer, and you never pull it out again. Ideally, right? Because if you have to pull it out of the drawer, something went wrong, drastically wrong, and you're looking at every word and what it meant and all that sort of stuff, right? So ideally, you put it in the drawer, you never see it again. Because if you do, you're having to look at it oh dear, what's going on, right? So it's a weird thing to spend that much money on a document that thick and that size that you hope you never see again.
What's the most common surprise or kind of challenge that occurs during an M&A process? you've seen it from both buyer and seller across multiple companies. Like, what's the one point of contention that you've kind of seen that's most consistent, kind of across companies? Is there one?
Possibly IP, maybe, right? Because they want to know what you have and how it works, right? And you don't want to show them, because if I show you, then you just go do it, right? A big company that can go afford to hire 50 engineers to go reproduce what you did, they've got the money to do that, right? So, but obviously they don't. Otherwise, they would just do it, right? So they want to know all the secrets, but you don't want to tell them, because then that's your secrets, right? So it's kind of like, we have this black box, if it's really code or technology. We have this black box, and I'm going to show you what goes in and what comes out. But I'm not going to show you how the sausage is made, right? Because that's our intellectual property. And if I show you, then you just go do it. You don't need to buy me anymore, right? So it's hard to get people comfortable with that. And so there's ways to do it, right? There's you can hire a third party that's bound by confidentiality that goes and looks at it, and they report back and say, oh, yeah, the sausage really does get made, it's really getting made. It's not magic, or it's not it is really actually happening. And the third party, I can't tell you, but I'm skilled in the art of looking at technology, and I can tell you that, yes, the sausage does get made, and you'll be happy when you get the box and you open it up and you see what's inside. So sometimes that's very contentious, because a lot of times companies, it costs them nothing to throw you a term sheet because it's non-binding, and then, oh, show me all your secrets. And then they go, oh, those aren't the secrets I thought that they were. We don't really want to buy you because I thought we were getting something different. So good knowing you. See you later. And then they go and talk to their engineers and go say, oh, go rebuild this, right? So that's the risk that you have to mitigate, is you can't show them. So typically the dance of looking at the IP is sometimes the trickiest dance to dance, I think.
Would you say that, kind of summing all this up together, that due diligence is important, not just from the seller to the buyer, but also from the buyer evaluating the seller? Yeah,
absolutely. It goes both ways, right?
Yeah.
So for me, if somebody buys my company, I hope to go keep working at that company for 10 more years and still be innovative and still doing the things we're doing. Only for me, I want to see my technology used on a much grander scale, right? This thing I created, I want to go see it deployed at 20,000 customers, right? Because that's cool for me to see, right? And obviously, finish my earn-out time and, get the money out of the, process that I hope for. So, so it's, people don't always think you want to do as much diligence on the buyer as they're doing, for you as well too. So and there's ways to go about doing that in a way that doesn't feel contentious to the buyer. I'm not trying to put you on your heels or whatever, but I just want to know what's life going to be like once we get this deal done, day one, what happens there. And then two, negotiations sometimes is weird. I had one seller when we were looking to sell the company, and we were always dealing with the corporate M&A guy. And we'd ask a question, and we would say hey, this is we have to have this, or it's not a deal, whatever. And he'd be oh, well, I don't know. Let me go get an answer for you. And he'd leave the room or go, I'll get back to you in 2 days, whatever. He'd come back, and we go through something else. Okay, this is I can't agree to this. This is just no way, right? Well, let me find out, right? So it's what's going on? Well, I have to go ask the CFO was the person that he was asking. It's okay, well, there's lots of these issues we're going through. Obviously, the CFO is the decision maker here, not you. You're just the corporate M&A guy. So why don't you just go get the CFO in the room so we can just sit down and hammer this out and save time, rather than you go away for an hour in person or whatever, or 2 days and get back to me. Let's just all get in the room, So always find the decision maker, right? The person who has the power to say yes or no to the terms that you want, and then things just go much faster, right? So, we literally just flew out and just sat down at a table, let's just hash this out and figure out where there, each deal point, I can give, I can't give, whatever, I got to give, I got to get, we're just hashing it all out, boom, 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 and then it can go much, much faster. But it was really weird because the guy purported to be the decision maker, but then you can tell he's not when you ask him a question, and he had to force him to make a decision. And he's I can't make that call because I don't have the authority. Let me go ask the person who does. Well, just get them in the room then. Make things easier. So learn that lesson.
Do you have any last piece of advice for people thinking of selling their business?
I don't know. If you really need to sell, it's tricky, right? It's great businesses are bought, not sold. If you have to sell, things are wrong. You want to get bought. You don't want to sell. You want to get bought, right? So if you have to sell something's gone awry. I feel bad for you, right? So, but it happens. Like sometimes you just need to. So, you just got to make two decisions. Like, do you want to run your own process and find the buyers and do your own thing and approach them and find them, or hire somebody that could help you? The problem is in small markets and mid markets, like investment bankers don't want to deal with a company that is looking for a $10 million exit because it's just not a big enough paycheck for them. So you have to go do your own thing and find buyers. And if your strength and superpower is starting and running a technology business, then your superpower is not finding buyers and creating a book of what you've built and marketing your company. Like, it's out of your comfort zone to do. So it's super hard to sell your own small company to small dollar amount. And these days I don't even know what the threshold is for investment bankers, like what the minimum is. Like, it's probably maybe like 20 million or so. I don't know. What would you say?
About that, yeah.
Yeah, like, so no one wants to touch it. So unless you think you can command a price of 20 million or more, then you can hire an iBanker, but they got to take their fee, right? But it might be just easier just to hire somebody that's what they do, with the caveats that I talked about before, I would say. So it's a hard spot to be in. Ideally, you want to get bought. You want people knocking on your door who want to buy you. You're in a much better position than I need to sell or I want to sell. Because then usually there's a time frame too that you want to sell by. Like, the cash flow is dwindling. I need to sell by X, or the market is slowly going away. I need to sell by like whatever. So selling is if you have to sell, it's just a very hard spot to be in.
It's good advice.
Get good advisors, board members, mentors, or whatever that have done it before that can help you with the process. If you can't afford to hire an investment banker, or it just doesn't make sense, that's when the time you invest early on to find the right advisors and board members will pay off, is at that moment for sure.
That makes a lot of sense. Bryan, thank you so much for joining us today.
Yeah, thanks for having me on.